Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth. How's it going today? Hope you're having a great day. Look, we do these videos day in and day out here. We're financial advisors at Jazz Wealth. Our goal is really just to help people learn more. And if along the way we can sort of prove that we take an interest and like and are knowledgeable about these things, we hope you'll keep us in mind at Jazz Wealth Managers. JazzWealth.com is a website. We're SEC Fiduciary Registered Financial Advisors, and that's a mouthful. So I'm going to go ahead and just dive into the content today. We use a few ETFs in our portfolios. Our portfolios are all right on the website there if you want to check them out, along with the performance and their objectives. But I see a lot of people using ETFs, and what happens is you tend to go down a path and you're using something that you become comfortable with, and then your mind just goes, well, what else can we do, right? It's like when you first got your car. When you're a kid, you drove around the neighborhood, you drove around the town, you drove around the state, and eventually you're like, well, what else can I do? Let me check out some other stuff, and sometimes that leads you into a little trouble. Well, there are 4 mistakes that I see people making, 4 mistakes with ETFs, and I want to try to help with some of these right now. The first one is by focusing on what they call themed ETFs. This is really, really popular right now, and in fact, the SEC is really focusing in on some of these companies that maybe shouldn't be doing this, but what a themed ETF is typically something that's an ETF that's launched around some kind of hype. So a great example would be YOLO. There's a new ETF for cannabis. That falls into the cannabis sector, and so there's an ETF for that. I'm not making a recommendation to buy or sell or anything. It's just something that's been sort of hyped. Cannabis has had an amazing run, and now what's happening? All these ETFs are coming out. You're seeing the price of cannabis start to fall. There's some coming out for 5G. I know some of you are really into the 5G that's coming out there. So that would be a themed ETF. Socially responsible investing, SRI, very popular one. That is also a themed ETF. Blockchain would be another one, just thinking of them as we go here. And so those are themed ETFs. The problem with a themed ETF, look at any of these. Let's use blockchain or crypto, for example. What happened? The price of that particular category of the market did really well. Then the ETFs start coming out, and that's what happens. Well, you see what's happening with like Bitcoin and some of the blockchains as well. But what tends to happen is you get sucked in by all the hype, and you go, oh my gosh, is there an ETF for this one? Is there an ETF for pot stocks? Is there an ETF for crypto? Well, by the time they come out, you're not interested anymore, right? You know, I haven't seen somebody post crypto on one of our afternoon shows in quite a while. So careful on these. These themed ETFs tend to come out after there's already been some significant rise in the price of whatever it is. All right, so that's the first thing, these themed ETFs. Number 2, buying ETFs you don't understand. And that's, I don't mean to pick on anybody, but ETFs can be difficult, right? They're not all index funds and sector index funds. There are ETFs out there that are incredibly complex. VXX is one. This is based on the VIX futures. And so, if you're one of those people and you understand how the VIX contracts are traded, what they actually represent, then you understand how this ETF could be a viable vehicle to play in an account that you have to have ETFs and you can't have futures. This could be a viable vehicle. But if you know enough about it, you'll know that there's a significant cost involved with it as well. And I don't mean the expense ratio, okay? So if you're not familiar with volatility or VIX-related products, maybe something you want to stay away from, or just do some homework and get knowledgeable about it. A lot of people look for these 2 times and 3 times ETFs. They're 2x and 3x leveraged. Basically, that just means, to make it as simple as possible, let's say you buy an S&P 500 2 times leveraged ETF. Well, if you look on the TV and you see that the S&P 500 gained 0.5% for the day, then the 2 times leveraged one would have gained 1%. If the S&P falls 1%, you would see that your 2 times leveraged ETF would have fallen 2%, right? So if the S&P loses 1, you were going to lose 2%. And so a lot of people look at those and they're like, ooh, right? That's like, man, put my portfolio on steroids, right? And so people get excited about that. Well, there's also a 3 times leveraged one. So if the S&P 500 gained 1%, you would gain 3%, all in that day. The problem with that is, in order to make that happen, there's a huge carrying cost. That's just the fancy way to say it. It basically means that there is a cost each day for that product. So these can be really great. They could be a lot of fun. They're great for active traders and day traders and the like, but they're not good for investments. And so if you don't understand how those ETFs work, you might be one that's investing in it, and come to find out you invest in it just before the summertime, all of a sudden it goes sideways and you're like, why am I losing money? The market's moving sideways. How am I losing so much money? So be careful with that. Now, in this same sort of category, there's something called inverse ETFs. I'll stop on this one for a second because people tend to really freak out about the inverse ETFs. Remember the 2x, 3x ETFs? Well, if there's an inverse attached to it, or sometimes the word short attached to it, basically that means that it will move in the opposite direction. So if the S&P goes up 1%, your ETF will go down 1%, or if it's leveraged, 2 or 3%. And you go, well, why would somebody want that? That doesn't make any sense. Well, think about it. If you saw the markets, let's say you're looking at the markets right now and you go, I think they're overbought. I would like to bet on them going down. Well, that's a way you can do it. The problem with it, again, huge carrying costs. If you're more advanced, you'll know this as a drag. There's a big drag, expense drag on the ETF. And so because of that, you really have to get your timing right? You've got to be in these things. You've got to score that move when it happens and get out of the way. So that's a little bit tough, right? So just make sure you know the products that you're investing in. That was basically all I wanted to say there. Understand how they work. The other ones that I would point out, maybe just now that I'm thinking of them, individual country ETFs, particularly China. China is not a one size fits all. You have A shares. I don't even want to get started on that. Bottom line is all those ETFs are significantly different, and you definitely want to know that. Okay, number 3, not looking at the weighting of the ETFs. You know, not all ETFs are created equal, for lack of a better word. Some ETFs are actively managed, meaning there are a group of people that make decisions about what stocks they want to own. And so what they could do is they could say, okay, we're focused on tech, right? And this is the tech ETF. They could literally choose to have this percent, whatever percent this is, let's say it's 65%, all in Amazon if they wanted to. The rest could all be split up over Microsoft and Salesforce or whatever. So you got to understand how they're allocating or weighting their portfolio. I should have said allocating here. It would have been a little bit better. All right. A great example, and I use this one all the time because this is a really easy one to understand, XRT and RTH. Right? I use these because they're retail sector ETFs. You want to participate in retail? Those are two of the most popular ones you could use to participate. However, the XRT is equal weighted, meaning they don't put preference towards one or the other. Every position is almost exactly the same size in this portfolio, whether it's Target, Home Depot, Walmart, right? Kohl's. These companies are all obviously various sizes, but it's treated as if they are all equal. The RTH, by the way, is market cap weighted. Just a fancy way of saying the biggest company gets the biggest position in the account. So make sure you understand the allocations and how they weight the individual ETFs. It really doesn't take a lot to do that, by the way. If you have an ETF that you're interested in, just type the ETF symbol and the word holdings or weighting or allocations right after that in Google or whatever, and the first 2 or 3 responses will be from the company that actually owns the ETF. All right, last one and the final one I'll talk about today, the mistakes that I see, is people find an ETF that is free or commission free or expense ratio free. And they go, okay, can't get much better than that. I think I'll participate in those. And then you place the wrong type of order. If you're going to look, just let's make a general rule. I'm making this up right now as I go. If you're going to look at commission free, let's just call them zero cost ETFs, right? And you'll see them out there. There's a bunch of them. They're becoming really popular. So there's no cost, meaning no expense ratio and no commission for trading them. Your brokerage firm says buy and sell all you want and you can keep them. Let's make a rule. If you do that, then you place a limit order, or I'm suggesting that you consider using a limit order. Can you tell I'm trying to be better with the regulators here? You're not going to place a market order. And that's really just common sense. That's That's not me like telling you what to do. It's just helpful information. I'm dancing around. Anyways, what happens with these low-cost or no-cost ETFs is the difference between the bid and the offer tends to be rather wide. That's how you end up paying more. So let's say that it's a $26 ETF. You've got this ETF X, Y, Y, X, Z, just so I don't get in trouble. It's a fictional ETF. It's commission-free, it's expense-free. It's $26 is the price that you see for the current bid. The current offer could be $26.70. This is your spread. So if you were to place a market order, you would instantly pay $26.70. You go, wait a minute, I want 26. That sounds like a lot cheaper, right? If you place a market order, you're going to get $26.70. You are now going to pay a 70-cent spread. If you place a limit order, you can choose. You can say, I would like to buy this at 26, but if there's other people here and they want to buy at 26, I'll go ahead and jump in front of them. I'll go 26.01. You may or may not get the shares at that point, but at least you can try, right? Because these people want to sell for $26.70. You may have to adjust that order and say, okay, $26.15, right? The bottom line is you will set the price that you're willing to pay. By choosing a market order, oh my gosh, I see this all the time, guys. You choose a market order, a couple days go by and you go, you know what, I don't really like this ETF. It's not moving, it's not doing anything. You place a sell order, market order, and you go, why'd that just cost me $1.50? I did 100 shares. How did I lose $150 just buying and selling over a couple day period and the ETF didn't really move? A lot of times it has to do with the spread. Now, not on all of them, but it's just something I like to point out. It's something that you'll want to consider. So number one, stay away from the themed-based ETFs. Let these areas of the markets prove themselves. Go with tried and true for now. There's no reason you are going to miss out on anything. Trust me, you'll be just fine. Number two, careful with the ETFs that you don't understand, right? Learn about them. It's a lot of fun. If you need help, let me know. If you're one of our customers, I'll teach you. I love teaching about this stuff. Number three, look at how they allocate the positions or how they weight the individual positions in there. Not all ETFs are the same. And number four, order types. When in doubt, consider the limit order. Market orders are best reserved for some of the big liquid ETFs if that's what you're going to do. Not always a problem, but I like to point it out. Anyways, if I helped you in some way, feel free to hit the subscribe button. That really helps us out. Leave a comment below. Let me know what you're thinking and be glad to help you in future videos. I appreciate it. We'll be back later for the closing beat and hope to see you there.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.